Welcome. This presentation will review and provide best practices for forecasting revenue sources for Massachusetts cities and towns. Before beginning, local officials are encouraged to utilize DLS's forecasting manual and workbook available online. These resources are designed to help local budget managers develop revenue and expenditure assumptions over a multi-year period. This spreadsheet shows an example summary view of a municipality's revenue forecast. Note that the projection provides a 5-year outlook, which should be included in every city or town's financial forecast. Developing a budget requires a data-driven financial forecast to assess the current and future state of a community's finances and to provide context for funding decisions. This is an essential planning and policy-making tool that projects revenues and expenditures over a multi-year period. Essential to developing and maintaining a forecast is the collaborative input among financial officers and policymakers. Similar to the budget process, when preparing a forecast, a financial management team should be involved in gathering data, developing available revenue projections, analyzing expenditures, and reviewing available financing tools while considering existing adopted financial policies. With a collaborative approach, various viewpoints and expertise of participants are represented and incorporated when developing forecasting assumptions. The forecast should be continually reviewed and adjusted as needed. To instruct the forecasting process, we recommend the community develop and adopt financial policies on various topics, including financial reserves, capital planning, indirect cost allocation, debt management, and employee benefit-related liabilities. A core set of financial policies provides guidance necessary for making decisions regarding the use of city or town resources. All communities have 4 major revenue sources, which will be reviewed in this presentation in detail. These are property taxes, also referred to as the tax levy, state aid, estimated local receipts and offset receipts, and other available funds, which include free cash, reserve funds, and other special revenues. Some communities have also adopted additional revenue sources, enterprise funds, and community preservation funds, both of which will also be reviewed in this presentation. The tax levy is the revenue a community raises through real and personal property taxes. Year-to-year increases in this revenue source are dictated by Proposition 2.5. The levy is calculated with a straightforward formula beginning with the prior fiscal year levy limit, which is the amount allowed to be raised, not the amount that was actually raised. To calculate the levy limit, the prior fiscal year levy limit is increased by 2.5%. It is increased by an allowance for new growth, which will be reviewed later in this presentation. Be sure to account for any overrides, underrides, exclusions, and other adjustments. Additional information on how Proposition 2.5 works can be found on the Division of Local Services website. As mentioned, the levy limit is increased each year by the amount of new growth. New growth is the additional value added to the property tax base from new construction or improvements to existing properties and other additions to the tax rolls. It can indicate whether or not the community is experiencing real estate development, and in turn, what to expect in terms of property tax growth. Conversely, it also can be an indicator of what, if any, new expenditures to anticipate with new developments, such as additional school children and public infrastructure. The financial management team should consult with the building and planning departments about permits and proposed construction within the city or town that might impact this analysis. Local officials should review 3, 5, and 10-year averages of new growth in each property classification: residential, commercial, industrial, and personal property. During this process, the driving forces behind growth should also be identified. For instance, a large-scale development could result in new growth that spans multiple years. Reinvestment in commercial and industrial equipment will produce a spike in personal property growth. When forecasting new growth, it is important to understand whether the growth is associated with a multiple-phase project that will impact new growth over multiple years, or is a project that has new growth captured all in one year. State aid is revenue and reimbursements received from the Commonwealth that changes annually based on legislative action. There are 2 broad categories of state aid. Education aid is primarily comprised of Chapter 70 funding that is designed to support educational spending and ensure minimum standards are met. Fully regionalized school district communities do not receive education aid, as it is provided directly to the district. General aid includes unrestricted general government aid, or UGA, that provides general purpose financial assistance to municipalities. Other types of general aid include regional library aid, reimbursements for veterans' benefits, and tax exemptions for veterans, the elderly, and blind. Aid is also distributed to reimburse the community for foregone tax revenues on state-owned land. Local aid amounts are first proposed in the governor's budget recommendation to the legislature, which takes place in January, unless there is a newly elected governor. In that case, the budget recommendation is due in March. These amounts can fluctuate as the budget process continues with the House and Senate budget proposals. The amounts are only final once the budget has been signed by the governor and the legislature considers any veto overrides. Local officials should monitor the budget process and update their forecast accordingly. It is important to remember that any proposed increases are not final until the budget has been approved. Lower estimates should be used until this occurs. It is important to analyze historic trends in aid distribution based on state and local economic conditions. Trends in school choice and charter should also be reviewed when forecasting other educational aid. A city or town's financial policies should govern the projection methodology for state aid. For example, forecasted amounts could be level funded or based on the average annual change in state aid distributions. Local receipts are revenues other than real and personal property taxes that are not earmarked for a specific purpose or use. Local receipts include motor vehicle and other excises, local option excises, penalties and interest, investment income, fees, and charges. Offset receipts differ from local receipts as they are earmarked to fund a specific service provided by the community. These revenues are estimated in the forecast and used to offset the service's annual operating budget. Examples of offset receipts include fees for water, sewer, trash, and ambulance services. Offset receipts are not widely used because there are more efficient ways to handle these revenues, such as using enterprise funds or receipts reserved for appropriation. Officials should understand the relationship between receipts and the local economy when forecasting this revenue source. For example, residents tend to buy new cars when the economy is good, which results in increased motor excise tax collections. This excise is typically the largest of the local receipts. Officials should also be aware of how the budgeted numbers compare to the actual receipts in order to prevent revenue shortfalls. Financial policy should govern the projection methodology for local receipts. For example, forecasts should not exceed 90% of the prior year's actual collections for local receipts estimates without firm evidence that higher revenues are achievable. This will help prevent a revenue shortfall due to overestimating receipts or an economic downturn. Officials should avoid budgeting receipts that are one-time in nature. Aside from locally generated revenues and state aid, a community may be able to draw on other funding sources. These can include appropriations of reserves, such as available free cash and stabilization funds. Receipts reserved for appropriation, such as insurance proceeds in excess of $150,000, waterway access fees, and PEG access fees are other examples. These also include non-recurring and special revenue sources, including overlay surplus and revolving funds. Financial policies should determine the use of other available funds. A community should not appropriate from reserves, whether it be free cash, stabilization funds, or any other non-recurring revenue to support the operating budget, pay any recurring expenditures, or fund employee wage increases. These policies should also include benchmarks and guidelines to build, use, and maintain reserves. Reserves provide a source of funds to address unexpected events or for current or future capital expenditures. As a local option, communities can adopt enterprise funds. An enterprise fund gives a community the flexibility to maintain a separate accounting and financial reporting mechanism for a municipal service for which a fee is charged in exchange for goods or services. These can include water and sewer, trash collection services, golf courses, and cable television and broadband access. Enterprise funds allow the community to account for the full cost of operating a service and retain reserves for capital and infrastructure needs. The rates charged for enterprise services are intended to cover operating costs and should be reviewed as part of the revenue forecasting process. Municipalities should adopt an enterprise fund policy to adopt their use. An enterprise fund can be self-sufficient or require a general fund subsidy to cover its costs. A municipality's enterprise fund policy should establish a funding methodology. The policy should also address indirect costs, which include employee benefits and insurances and non-enterprise employee costs. These costs should be defined and calculated according to a formal indirect cost policy and reimbursed to the general fund. Because enterprise funds are only authorized for fee-based operations, they often have operational capital needs that should be factored into the long-range forecast. Enterprise revenues in excess of expenditures are certified as retained earnings, the equivalent of free cash for the general fund. Retained earnings should be treated as a funding source for one-time expenditures and capital needs. Great care should be used when forecasting these enterprise fund revenues. This will help prevent deficits that would need to be funded by rate increases or from the general fund. Communities may adopt the Community Preservation Act to establish a community preservation fund for open space acquisition, historic preservation, affordable housing, and outdoor and recreational facilities. Revenues come from a local property tax surcharge of up to 3%, as well as matching distributions from the state. These distributions can fluctuate based on the number of communities that have adopted the Community Preservation Act and volume of real estate transactions. To forecast the community preservation surcharge, review and use historical revenue trends and tax levy increases as a guide. Here are some key takeaways to remember when your community is developing its forecast. All members of the financial management team should be involved. Financial policies should govern how the forecast is developed. These policies should be reviewed and updated as needed. All assumptions should be realistic, concise, well-documented, and conservative. Continually update the forecast as information becomes available. Brief policymakers on the forecast periodically to keep them informed. Finally, do not base revenue projections on the city or town's spending needs. Any gap between revenues and expenditures should be balanced during the budgeting process. For more information on this topic, please visit mass.gov/DLS.